Thank you, Tembegile. Well, we start here tonight. FNB's interim results paint a picture of a broader resilience in the South African banking sector. The bank reported a 31% increase in pre-tax profits in their interim results, along with an improved return on equity of 39.7%. Business reporter Tumisang Ndlovu earlier caught up with FNB CEO Jacques Celliers. This is how that interview went.
The last 6 months is probably an outcome of a 2-year effort from us as a business. If you remember, take back 2 years, story was staring the pandemic. We knew that it was going to take some time for us to normalize back. And we expected in our thinking that it's going to take us probably 3 years to get back to the 2019 sort of framework. And the outcome actually after 2 years is very exciting. I mean, for us to have got through this, been back to normal, if I can call it 2019 as normal, we're delighted with the results. It also is a good indicator of momentum going into the next year, next 6 months certainly. And then on the back of it, sort of a little bit of a credit cycle uplift. We're excited that would stimulate more growth. And then on top of that, we think the structural stuff that everyone has been talking about seems to be slowly becoming a reality. Our clients through COVID, awesomely well positioned, balance sheet strong, and it's about that growth now that the market hopefully would see we can get. So we think we're on the front foot.
The performance that we are seeing on the South African economy, for consumers, it usually is not as near-term as an effect as one would expect, but the results are showing a different picture, especially of a banking consumer that is bouncing back too with the dynamics of the South African economy.
Yeah, I mean, a lot of base effects in that. Clearly, it was a year where no one got a bonus and no one got an increase, and people were struggling with a really basic parts of earnings. And as the market opens up across sectors, you can see a little bit more breathing space for people as they get a bit more activity. And some sectors are pumping, flying. I mean, the agri sector and the mining sectors, as you know, are really doing very well. And others are still a bit lagging. I feel very sorry for the international tourism sector that really was poised for a very good December, and then that was disrupted a bit with the wave that hit them again and a whole bunch of. But somehow it seems though the local economy, the local tourism certainly was able to step in there a little bit. So from all angles, it looks as though people are able to keep the lights on, which is a really, really good space to be.
You indicated that there are structural reforms that are starting to be addressed. Was that an indication that there's full confidence in the likes of the State of the Nation address, the budget policy statement that was just delivered recently, that there is work in terms of cultivating the South African economic landscape to be conducive for business again?
Yeah, I mean, I think it at least this time round there was a little bit of support. For example, I think the fact that we had such a benefit flowing from the commodity support as the prices, obviously from a COVID perspective, that is the fiscus really benefited from a few levers that they didn't necessarily plan for. So then it becomes a little bit more easy to have the sort of growth agenda and support agenda going. So I think that played out, and even now with even further disruptions in supply chains and commodity stuff, I think around the world with all the geopolitical risks, we think that there's another step of another set of support that's going to come from commodities, which will help us a bit. It gives us a bit more breathing space to get our ducks in a row because the structural stuff are really needed.
The IMF's report that came out a couple of weeks ago, where they were flagging concern around the state debt that is sitting in South African banks. What is your position on that print?
Yeah, thanks. This morning at the results presentation, Alan also spent a lot of time on that. It doesn't look as though we are out of sync with the rest of the world. The report just flags the fact that there is that observation. But it was a natural consequence, even in hindsight, it's not obvious, but you could have almost like expected it, where the demand, for capital utilization in the local economy through our franchises really wasn't there to absorb all the capital. And what you would then do is you would put it in, in high quality sort of instruments that we could get out of governments. And so you would expect now the pivot to be back into the market. And I think to the extent that we can get that economy growing and going again, that would easily be sort of unwound and find itself back into the economy again. So I think it's a natural consequence of all the support the government had to give the market through the pandemic. And we hope that, as I say, to the extent that the economy can absorb that, then that just slowly unwinds itself again. So I don't think it's anything that we would see as out of normal or to a global sort of experience, but it is a data point to keep on looking at.